Welcome back to Investing Wizards. I have the pleasure of having Puru Saxena, who is, it's a second time appearance, and what a year it's been since you've been here. Welcome back to the show, Puru.
Oh, my pleasure. Thank you very much for having me on again.
So let's get right into it. What the hell is going on? I think just to kind of like set the background, you were super bullish after COVID, after all the Fed liquidity. Started getting bearish earlier this year, which people got very confused by because they sort of painted you as a perma bull. So maybe you could tell us kind of like what you're thinking about things and what's happened over the past year.
For sure. I mean, basically, when the Fed launched QE, it was unprecedented. It was a massive stimulus, and also the governments all over the world, especially in the US, they basically injected trillions and trillions of dollars into the economy, and basically gave stimulus checks and money sent to households to spend and so forth. And when the monetary conditions became very loose, it became pretty obvious to me that asset markets were going to go up. And I was super optimistic and bullish about asset prices, stocks in general, and growth stocks in particular, from 2020 all the way up to sort of mid 2021. Admittedly, I basically did not see the first leg down in February 2021. I missed that one. I did not think that the most speculative areas of the market would peak so early whilst QE was still going on. But in hindsight, the benefit of hindsight, if you look, the rate of change of liquidity peaked at that point. And that's when the most speculative areas of the market got hit. And then we had a tough summer, and then towards October, November, when the Fed started talking about withdrawing the stimulus and ending QE, and when we had the scary high CPI print in early November, that's when growth stocks really started getting hit badly. So basically, I've studied the stock market history going back 100 years. I mean, I haven't obviously been alive for that long or active in the markets, but I've actually looked at the bull and bear markets in equities going back 100 years. And one thing which stood out to me when I was doing my research years ago was that whenever the Fed was easy and liquidity was abundant and credit was flowing, stocks tended to do quite well. For sure, they had periodic pullbacks, but all the major bear markets, all the big disasters happened after a period of monetary tightening. And this trend became even more exacerbated after the GFC, the global financial crisis. So, when the market collapsed in 2007-8, we had the TARP programs, and then the Fed started QE. And there was a very interesting correlation between the S&P and QE, that whenever the Fed did another round of QE, the S&P went higher. And when the QE stopped, the S&P went through a pretty sizable pullback every single time without any exception. So in 2011, we had about a 20% pullback in the S&P. And then we had the next round of QE. And then in 2015, we had another 15 to 16% wobble in the S&P, and more so in the growth stocks. And then we had another rally. And then in January 2016, we had another 15 to 20% sell-off in equities in the indices in the US. So, and the same thing happened afterwards. In 2016, the ECB launched QE, and that basically pushed stocks higher for another couple of years. And then when the Fed started quantitative tightening and shrinking its balance sheet in 2018, we had the volatility shock, when the VIX spiked like crazy, and a lot of these short VIX strategies blew up. And then we had a rally into spring, summer, and then we had a pretty tough fourth quarter in 2018 when the S&P fell another 20% or so. So when I put it all together on a chart, I realized, that the QE was responsible for the massive gains in equities. And whenever QE ended, there was a big decline in equities, and more so at an individual level, and about a 15 to 20% pullback in the index. So that's why, I started cautioning in my tweets come sort of August, September 2021 last year. And I said, that the music is playing right now. And when the music is playing, everybody looks like a genius in the bull market. but the litmus test is what you're left with after the subsequent bust, which always comes. And lo and behold, a lot of the keyboard warriors on a Fintwit who have never seen a bear market before, they started, saying to me, "Oh, you're a boomer. You don't know what you're talking about. Stocks, buy the dip, YOLO, your life depends on it, all sorts of stuff that you've lost the plot, basically." And, I was obviously, basing my thoughts on experience and also on actual stock market history. And I was just chuckling to myself, thinking, a lot of these people are going to learn a very painful lesson whenever the music stops. And the music did stop in early November, and we've had this horrendous crash in growth stocks, in high growth stocks. Most of them are down 50 to 80%. And now everybody is bearish on growth stocks. Everybody's making fun of Cathie Wood. And everyone is saying these are speculative garbage companies. They're never going to come back. And coincidentally, I've been buying back into these growth stocks over the last few weeks, scaling in gradually. And I've just now fully invested my portfolio in my preferred companies. I think there may be a bit more downside, especially if the indices come off another 15% or so, which is my expectation. I think the S&P may come off to around 3,800 or so, and the NASDAQ may come down to sort of 12,000. The NASDAQ 100, I suspect, may come down to around 12,000, 12,200, that sort of area. So if we do get another 15% pullback in the indices, it is conceivable that the high growth stocks may actually get caught in the fire. And they may come off a little bit, but I'm kind of expecting them to show some relative strength. That is my belief. I don't think they're going to get absolutely murdered now, because we've already had a big crash in the rearview mirror in the space. So I think pullbacks in the high growth space should be bought. People who are looking to invest for the next 4 or 5 years or longer, they should utilize this period of fear, of panic, of loathing towards the growth stocks, and gradually build their positions over the next couple of months or so. I think the best strategy is probably to just dollar cost average, and just pick a day every week, and just say, I'm going to commit 15% or 10% of my capital every week for the next 8 to 10 weeks. And I think if people who do that are going to be rewarded quite handsomely over the next 5 years or so. So that, I just think, there's more pain ahead in the near term, simply because the QE is ending, and the Fed has indicated that there are going to be some rate hikes, and if needed, then QT. I don't think we are going to get significant rate hikes. I suspect if the S&P and the NASDAQ come down maybe 15% or so, then at some point the Fed will fold like a lawn chair and cave and back off from the hawkish position, and that will ignite a massive rally in the growth stocks and equities in general in the back half of the year. I think we're going to see an important low in the stock market over the next sort of 6 to 8 weeks.
Okay, wow. There's a lot to unpack there. And can you see my screen, by the way?
Yeah, I can.
Okay, great. So I'm just gonna, I was playing around with some stuff as you were talking about it, but you were sort of covering so much material. So let's back up here a little bit. So what I wanted to do was kind of use Koyfin to pull up a very long-term view of the S&P 500. Actually, let's go back all the way to 1986. And this is, so what I have here is in the red line, I have the S&P 500. I have here the Fed balance sheet, which is ticker WALCL. And obviously the Fed only started using its balance sheet in 2008. That was kind of like the first time that they started expanding. And before that, and this is the change in the balance sheet. And before that, it was really kind of the Fed funds rate. That was the mechanism that the Fed was using to control liquidity. And you sort of made a really interesting point about kind of like studying history and looking historically at what happens. And whenever you have whenever the Fed starts withdrawing liquidity or increasing the Fed funds rate, which is depicted here in the bottom graph, you typically have problems in the SPX. That's when the real kind of like sell-offs or the drawdowns happen in the SPX. I'm just going to pull up drawdowns over here with a line here. So even in 1986, this was kind of like the Fed was withdrawing liquidity. I think you alluded to kind of like the late 90s. The Fed started withdrawing liquidity by raising rates. And then similarly now, even though the Fed hasn't started hiking rates, this is something that they've been shifting to. And this, at least the pace of the balance sheet expansion has started to decline, and the market's sort of foreseeing that. How do you, so you mentioned kind of, you mentioned your framework of kind of thinking about this Fed liquidity and thinking about kind of less liquidity being bearish, more liquidity being bullish. What I have noticed when I think about the market is sometimes you have periods of consolidation and the market starts rallying even as the Fed is hiking, and other times that digestion or that incorporation of higher rates causes the market to sell off to be much more severe, which is kind of what's happening now, particularly in growth stocks. How do you think about like the Fed is going to keep raising rates and the market is going to rally at some point? How do you square those things? When do you know to turn bearish, when the market sort of looks past the Fed raises?
Well, there's a couple of factors. First of all, whenever the rate hiking cycle is fast, in other words, when the Fed becomes aggressive pretty quickly, again, is the rate of change, then the S&P historically has had problems. When the rate of change has been slow, when the Fed has basically gradually, hiked rates or gradually removed the punch bowl, then by and large, if the valuations have been reasonable, the S&P has been able to withstand the tightening. So it basically comes down to what the previous stimulus was, how massive it was, whether the economy is accelerating or whether it is decelerating, whether the PMIs are going higher or they're already peaking out and headed lower. So it depends on the valuations also to some extent. If equities are cheap, then obviously, they are less vulnerable to monetary tightening. Whereas if the equity market is pretty overvalued and valuations are pretty rich like they are now and they were a couple of months ago, then the equities have been more vulnerable. And the big bear markets in the past, before this QE malarkey started, was basically the big bear markets and recessions always happened, Rob, after the inversion of the yield curve. Mm-hmm. So whenever the Fed basically over-tightened and the short-term interest rates, the 2-year yield on the US Treasuries, exceeded the yield on the 10-year note or the 30-year bond, that's when we had problems several months later in the stock market and also in the economy, because that meant that the Fed had over-tightened things and become too tight. So, if you look at the economy, people talk about the business cycle, but the business cycle really is only the credit cycle or the liquidity cycle. So when interest rates are low and the central banks are promoting, lending and borrowing, and they want to stimulate the economy, and they drop rates and they make money cheap and credit plentiful and so forth, then, people try to speculate, they borrow, they invest, the business activity picks up, businesses start spending, investing, and so forth, and you have a boom in the economy and stock markets generally head higher. Conversely, when the liquidity becomes tighter and the credit becomes more expensive and the central banks remove the punch bowl, then the reverse happens. The business activity slows down, credit creation slows down, risk appetite diminishes, people borrow less, they speculate less, and so forth. The whole process reverses, and when you have all of that, then obviously the corporate earnings get affected as well, and then the stock prices come down to reflect the new business reality. So it really is a credit cycle or a liquidity cycle, and as long as people can, generally get a good idea of where we are in the cycle, then it is not very difficult to, ascertain whether the next 6 to 12 months are going to be very favorable for stocks or it is a time for caution, as is indeed the case right now.
Cool. So I just pulled up the yield curve since the 80s. We have the SPX here. Just going to make this drawdown chart a little bit lower. So you're basically saying that if the yield curve is a representation of the cycle, and when the yield curve is steepening, the economy is accelerating because the 10-year yield is going up because the market is anticipating inflation. And then when the yield curve is flattening, basically the cycle is slowing because the long end is anticipating lower growth, nominal growth, whereas the short end is going up because the Fed is probably tightening. And at some point it inverts and goes negative, where the 10-year yield is lower than the 2-year yield. And historically, this has been a really good predictor or really good indicator of an upcoming recession. So 1990, 2001, 2007, 2019 actually kind of like touched here and reaccelerated, and now we are we're declining. So how do you think about kind of, we're not negative yet, but we've gone down from 165 basis points to about 65 basis points. So about 100 basis points drop. So how do you think about kind of like where we are in the cycle in terms of us declining, but not being negative yet?
Well, I don't think we are going to see a recession this year. I think this is more like a mid-cycle slowdown in the economy, which has basically been appearing in the cycles going back many, many decades. So I think before we hit recession or before the inversion, the Fed is going to back off. I think the Fed put rope still exists. I just don't think it exists at these levels. I think if the S&P and the NASDAQ come off another 15 to 20% from here, then the Fed will basically back off and back away from its hawkish commentary and tone and say, okay, we've ended QE, now we are going to raise rates perhaps 1 or 2 times or 3 times and then take it slow and become data dependent and all of that. And that will be music to the stock market's ears. And then we are probably going to see a big rally in the back half of the year. That's how I'm thinking anyway. I don't think we're going to see a recession this year.
And, just looking at this chart, and obviously you mentioned a lot of stocks are down 80%, and it sure feels like a big recession or a big bear market. But the S&P drawdown has only been about 10%, and sort of been, if you look at the broader index, which obviously includes a lot of defensive names, a lot of safe haven names, a lot of deep value names, that actually hasn't sold off as much as some of the growth names. Cool. So you're pretty open in terms of your system and kind of how you think about the world in terms of investing in growth stocks, but also hedging. And one of the things that I really like about your framework and your discipline is that you basically let the market hedge for you, or you think about hedging as hey, when the market's in a downtrend, I'm hedging. When the market's in an uptrend, I'm not hedging. So for those of you that aren't following kind of like your work, which indices do you use to think about kind of if we're in a downtrend or an uptrend, and what are the indicators that you're looking for?
Sure. I mean, basically, I use the ARK ETFs, so ARKK. Mm-hmm. So because my portfolio is comprised of about 20 high growth companies, so I found that in terms of correlation, the ARK ETF is probably the best in terms of the correlation with my own holdings. Mm-hmm. So I don't want to be hedging the S&P or the Dow if I'm invested in high growth companies. If they are getting shot and the Dow and the S&P are making new highs, that doesn't really work as a hedge for me anyway. Mm-hmm. So that's why I use ARKK. So what I use is basically, I use a primary trend filter, which is a medium-term moving average. Mm-hmm. I mean, you can say use any average. You can just plug in, say, 50 exponential moving average. So that is my primary. I mean, that is not the one I use, but I'm just giving you an example, like a 50-day. Okay. And then I use a 5 and 7 EMA cross. So 5-day EMA and 7-day EMA.
Cool. So we're going to put these down here. And so these would probably have to go to, let's put the crosses on a separate graph.
Well, you can just put it on the same one and just make the graph chart sort of shorter. So the moving averages are more clear for people to see.
And we'll just make this a little bit, maybe 7-day. Okay. And then the 5-day will make black to make it a little bit more obvious. So you're using, you're basically using this cross as a short-term signal, this 5-day versus 7-day.
Yeah. So basically what I do is when the price goes below my primary trend filter, which is a medium-term moving average, then I see the positioning of the 5 and 7. So if at that, say for example, if any trader or any investor is using this system, which I've just described, with a 50-day exponential moving average as the primary trend filter. So if the price is above the blue line, then you don't hedge. You just absolutely ignore the 5 and 7 cross. It's irrelevant. When the price comes below the blue line, that means that the trend or the primary trend of this particular ETF is down. And at that point, if the 5 EMA is also below the 7 EMA, that means even the short-term trend is down. And that's when you hedge. And when the 5 EMA goes above the 7 EMA, you remove the hedge.
So this is so right now they're sort of almost at the same exact. So I'm not, your system maybe has different values, so I'm just using an approximation. So this is why we're pretty close, or the 5-day and the 7-day have been sort of crossing each other.
The 5 is still below the 7.
The 5 is still below the 7, but they've been sort of like crisscrossing. So like a couple of days ago might have been above. And is this why you're sort of saying, hey, I'm likely going to remove the hedges soon?
Yes, when the 5 crosses above the 7, I remove the hedge. If the 5 goes down below the 7, I put on the hedge again. And I keep doing that as long as the price is below the blue line.
Got it. So there's, okay, so just to summarize, there's kind of like 2 things you look at. One is the overall price versus the 50-day, which is like the thick black line here. And as long as the thick black line is below the blue line, we're sort of in a downtrend. And then the second thing is this kind of fast moving indicator, which is the 5 and 7-day. And if the 5-day is below the 7-day, that's when you keep the hedge. If it's above, you remove it. And then when the price goes above the 50-day, then we're not in a downtrend. So you don't care what the 5 and 7 are doing.
Correct. If the price is above the primary trend filter, which can be a 50-day or a 60-day or 40-day, whatever you want to use. If the price is above the trend filter, like it was, in 2020, 2021 early, then there is no need to hedge, because the whole point of hedging is that when the market becomes wobbly and uncertain and the main trend is downwards, the bias is downwards, that's when you want to protect your portfolio and become market neutral as much as possible. And when the price is trending higher, like it was in 2020 and 2021 up until January, February, then you don't want to be hedged, because you want to participate fully in the craziness which goes on in the markets. So the idea is to be long as much as you can during strong uptrends and basically defend capital and become market neutral when the trend shifts from up to down.
So what happens when you're in a choppy market? So for example, let's say kind of like this regime over here where you have a cross above. Are you removing your hedges and then putting them back over here?
Correct. If the price shoots up above the primary trend filter, I get out immediately. I put in my good till cancel stop buy orders in my broker platform, and then if the price goes above the primary trend filter, I'm out immediately, and then I wait for the next signal. So the idea is to not be right every single time. I'm not hedging to make extra money. I'm only hedging to protect my portfolio from nasty downside, downswings like we get periodically in the markets from time to time.
Got it. And so even sort of like in a scenario like this where you have a little bit of a chop with the 5 and 7, you're trading your hedges. You're taking them off and putting them back on.
Yeah, I think there's something wrong with this, because if I remember correctly, in November there was no chop. I don't know why this is showing a chop
for
5 and 7. Yeah, because
you're saying.
Because in November it just went straight down. There was no chop at all between 5 and 7.
Got it. Okay. So
no, you're getting confused, I think, because the dark line in your case is the price, right?
Well, yeah. So let me switch this. The 5-day I'm going to put as a red line, and so the black line now is the price, and then the red.
Yeah, that's irrelevant. The price can go up and down. It doesn't matter. What we are looking at is the cross between the 5 and 7.
Got it. But if the price is above the 50-day, then the 5,
there's no hedge.
Then there's no hedge. Correct. Okay, got it.
Like so here, if you see, in early December, the price bounced and it went above the 2 moving averages, but the 5 remained below the 7. You see?
Yep.
So I did not do anything there. I just stayed with the hedge.
Oh, there it is. Yeah. So kind of like the 5-day stays below the 7, even despite the price bouncing over here.
Correct.
Got it. Okay. And then late December, there was a little bit more of a chop.
Correct. That's when I got out, and then the price headed lower again. So I put them back on again immediately.
Yeah. So your strategy is not a great strategy for kind of in a market that's moving sideways or where there's chop, but your style of investing is focused on companies that typically have really big trends, and so you're just setting up for that next trend and protecting your capital until then.
I mean, what I'm trying to do is to invest in the best companies that I can find, the high growth companies, because I've seen research from Morgan Stanley, I've seen research from some other quants, which have made it clear that, over the last 20, 30 years, the biggest stock market winners were those stocks which had the maximum revenue growth. So, the valuations mattered on a 6-month or a 1-year time frame, maybe on a 2-year time frame, but over a 10, 20-year period, revenue growth was the single biggest factor or determinant of long-term shareholder returns. And not even free cash flow growth or EPS growth, it was about revenue growth. And as long as the companies are growing rapidly and they're not burning too much cash and they have a path to profitability and the margins are decent, then logic says, if a business is a lot bigger 10 years out, and if it's going to start making money, then obviously, the company's market cap is going to adjust upwards. The problem with value investing is if you try and find an undervalued security, there's not generally, with typical value investing, you're not really looking for high growth companies. Most value investors look at the mature companies which aren't really growing. They try and look for bargains. And the problem with that strategy is that even if you identify a company which seems cheap, say 20 or 30% below what you think is the intrinsic value, once it comes back to its intrinsic value, then you can't really hold it any longer because there's not much growth in it. So you've got to sell it, and then you've got to look for something else. So it is a continuous buy and sell. And whereas if you invest in these secular compounders, which have got a long runway, and companies which can grow for 10, 15 years at very high growth rates and keep compounding, then you don't have to worry about, buying and selling that much, unless you have a massive mania like we had in 2020, 21, when stocks went to 5, 6x, 8x in a year. Then obviously, if you want to preserve your gains and if you don't want to participate in the downside, then perhaps you can take some off the table. But the idea is that if you invest in the high growth compounders, then you don't really have to play the buy and sell game very often. And it's a lot easier to find a handful of strong companies which are going to grow than look for bargains continuously and try and flip them over when they reach intrinsic value. That's what I've found anyway.
Cool. Okay, so you're kind of switching gears to some of your actual individual holdings. What I did was I created a dashboard on Koyfin. Where we have this feature called My Dashboards, where you can sort of create a dashboard with different widgets. And so I have a dashboard here with a bunch of your holdings. And do these look familiar?
Oh yeah, they look like my companies.
Yeah, cool. So I looked at kind of like the tweet that you put out in February with your portfolio and just imported those in. And so this is kind of the portfolio that you're looking at. How often are you changing stocks in your portfolio in a given quarter or a given year?
Well, I've been more active than normal in the last couple of years, simply because the QE was insane and the mania and the craziness that we saw in the markets was also insane. I was picking stocks and investing in them, and within 3 or 4 months, they were, doubling, tripling, quadrupling. And I was thinking, this doesn't make any sense whatsoever at the valuations that they were trading at, 2021 in sort of spring. It was pretty clear to me that they were not going to make much money over the next 4 or 5 years, because the market caps had become so large in relation to the revenues and cash flows. My best guess at that point was that, I'd be lucky if I can break even in 3 or 4 years' time. So I actually had to sell. I was forced to sell some of these big winners, because I knew, once the vaccines came along and, the economy started reopening, people would start getting out of these COVID beneficiaries and look at some of the value plays, some of the beaten down names. And it was sort of my belief at that time that we would see a multiple compression in these high growth names, which had become absurdly overvalued. So I actually took a lot of my money off the table. I sold a lot of companies like Zoom, some of the other winners, Livongo and stuff, when it merged with Teladoc. So I got out of all of these COVID beneficiaries a few months after the vaccines were announced, and I picked up some starter positions in some of the other stocks which did not work out very well. So I've basically narrowed it down to about 20 companies. And one of my goals going forward is I don't really want to, change my portfolio over very much. I want to reduce the portfolio turnover to maybe 15, 20% a year, if that, because I just have realized that there's no point in trying to own everything. What matters is what you actually own in your portfolio, not what you miss, because your P&L is determined by what you have in your portfolio, not what you may have invested in. So what I'm trying to do now, Rob, is just to invest in 20 really solid companies, which I think have got potential to keep growing for the next few years. And as an investor who invests in high growth companies, I'm always on the lookout for new IPOs and listings and stuff, because I have found that if you invest in new listings, new IPOs, direct listings and stuff like that, then the first 7 or 8 years of a new company are the sweet spot in terms of their public life. So, the stock generally tends to do exceptionally well of a great business in the first 5-7 years when it is going through a period of hypergrowth. So I try and catch those. So I'm trying to basically, hold about 20 companies in my portfolio. And, this year and going forward, I will keep an eye out on new IPOs, new listings and so forth, but I will try and keep my portfolio turnover down to maybe 10-15% a year and just let these companies do their thing.
Got it. So these are some of the kind of like the solid companies that are winners in their space or in their sector, growing very quickly. So I just have here a bunch of columns, and one of the things that I have is revenue growth. So revenue growth for next year, revenue growth for the second year out and the third year out. And so these companies are growing about 60% this year, 45%, 40% the following year. I'll use the average here, 45%, and then about 40% the following year. So this is what you talked about, focusing on the highest growth companies.
Absolutely.
Yeah. And then just to kind of like flip it on, you mentioned before, I just have a template here with some valuation metrics. I'm just going to put that in here and then add an average similar to what we had here. So if I look at the price to sales multiple, it's about 23 times, and an EV to sales multiple of about the same. And this kind of like goes along to what you were saying, is that this doesn't bother you for a company that you believe in for the next 5 to 10 years is going to grow very quickly.
Correct. I think. Sorry, go ahead. I cut you off.
No. So, like, is there a multiple? You talk about in your market framework in terms of thinking about the Fed and liquidity. You do mention valuation. So it's interesting that you do think about market valuation from a macro concept, but from a stock concept, it bothers you less. So how do you kind of square those things up in your framework?
Okay, so what I look at, I don't actually pay attention to the current valuation multiple in isolation when I look at these companies. So what I try and look at is, what this company is generating now in terms of its revenue, in terms of its cash flow. What is this company going to generate 4 or 5 years out? What are the analysts saying? What is management saying? Has the management given any long-term performance, numbers? What are they trying to achieve? What is their long-term gross margin expectation, operating margin expectation? How much free cash flow is the management hoping to generate 5 years out? So I do some rough calculations in my mind. I see what the business might generate in terms of revenue 5 years out. If the company compounds at 30% per annum over the next 5 years, then, if it's generating $10 now, you can work out how much it will generate 5 years out. And then I look at, 5 years out, I try and see what this company will be generating in terms of revenue, and how quickly will the company will still be growing. So if it's growing at sort of 20% at that point, because obviously growth slows down with size, then I look at the comparative companies trading today in the space and say, okay, what sort of multiple are these companies getting today from the market? For example, in the software space, if you look at Adobe, or if you look at ServiceNow, or if you look at Salesforce, which are obviously larger companies and more mature in their life cycle, then you can see, they trade anywhere between sort of 10 to 15 times revenue. and they're growing at 25-30% a year, or to about mid-20s, low 20s to 30% a year. So a lot of these companies that are currently owned, I suspect they will basically be growing at about 25-30% 5 years out. So I basically do a calculation in my head and I say, okay, if this company is generating X amount of revenue 5 years out, and if this company's multiple, then the EV to revenue multiple is say 10 or 12 or 15, what will be the market cap 5 years out? What is the market cap today? And if I invest now at this market cap, and if the market cap, if 5 years out is, a triple, then I can expect to generate about 20%, 18 to 20% annualized over the next 5 years as a shareholder. So these are the sort of calculations I do. And I think that's one of the things a lot of investors tend to sort of miss out on. They ignore it. They look at the current valuation and they get a sticker shock and they think, oh my God, I'm not paying 20 times or 25 times revenue for any company.
Mm-hmm.
But they actually don't look at the margins of the company. They don't look at the qualitative aspect of the business. They don't pay attention to why this company is selling at a rich multiple. And one of the things I've observed, Rob, and I've commented on this quite often on my Twitter feed, is that the best businesses always appear overvalued.
Mm-hmm.
When you are going through a bear market, they become cheaper, but they still remain pretty expensive.
Mm-hmm.
And when you have a raging bull market and you have very easy monetary policy and things are going up like crazy every single week, then the valuations just become totally nuts and absurd. But even during crises, the valuations of these companies don't generally get into a bargain sort of territory, simply because the market tends to know that these are the best, highest quality growth names available with the longest growth runways and durable growth and so forth. So the valuations tend to remain elevated from an average point of view. So if you look at companies today, like Datadog, or if you look at Snowflake or Sentinel-1 or Confluent, these companies which have got a very long growth runway, very, very high growth rates, fantastic management teams, very high margins, and everything trending in the right direction. Even now, even though we've had a 50 to 80% washout in the high growth space, their valuations are not cheap. Mm-hmm. So somebody who only looks at the current valuation might say, okay, this company is just extremely expensive. I'm not going to invest in this. And, in my point of view, I think that is a mistake. I think these growth companies have to be valued based on what these companies might look like 5 years out, as opposed to what they look like today.
You have a bunch of companies here that we use at Koyfin in terms of our tech stack. And I can tell you that those companies are very intertwined into our workflow, and specifically GitLab, Snowflake, and Datadog are two companies that are just, if you think that engineering and engineering organizations are just getting bigger and bigger, at least for us, these two companies are just a core part of what we're doing on the development process. So maybe we could talk about some names individually. So I have kind of like a chart here and your names here. Curious, maybe if we can start with, let's start with C Limited, because I want to hear your view on kind of just, one, I want to hear your view on C, but also if you have any views on what's going on with China, because there, as a theme, those stocks have gotten killed because of some regulatory and political uncertainty. How are you looking, how are you using that to evaluate C Limited?
Well, first of all, C is not really a Chinese company. It's actually a Singapore-based company. Mm-hmm. And Singapore is, a 5-hour flight from Hong Kong.
Yes. As an American, I think Asia is just one big country.
They all seem the same, but they're not.
Right. But they do. But sorry, does C have any business do they have a business in China though?
No, they don't.
Okay.
They basically have a partnership with Tencent, and Tencent is a shareholder.
Got it.
So they have the right for first refusal for Tencent's games outside of China, and they have a strategic partnership with Tencent. But the bulk of the business is actually generated from the Southeast Asian region, which is hence the name C, Southeast Asia. So Southeast Asia is where they operate. They've also started expanding into Latin America, India, parts of Europe and so forth in e-commerce. They have a digital entertainment business, which is called Garena, a video gaming business, which has been a profitable cash cow for them, which has enabled the company to, use the cash flows and the profits to invest in the e-commerce growth. And they also have a very small and upcoming fintech payments division. So it is an interesting company, basically founded by Forrest Lee, who's actually still the CEO of the company and a major shareholder. The company has done really well. The operating results are still pretty decent. The market basically hates the stock right now because it is high growth, and the stock has been pummeled over the last 3 or 4 months. And in my view, it has become extremely undervalued. It is trading at an EV to revenue multiple of around 6 for year end, which is absurdly low for a company of this quality and this sort of growth runway ahead of it. I think, shareholders or investors who gradually buy into this company over the next 4 to 6 weeks are likely to do very well over the next 4 or 5 years.
So I love looking at this chart. This is one of my favorite charts to look at, which is looking at the stock price versus the next 12-month revenue estimate. And so first of all, this company went from less than $1 billion in revenue in 2019 to $13 billion today. So that's quite the growth rate. And what's interesting about the sell-off is that estimate hasn't really changed. You had a slight blip here. I'm not sure what's going on here. There may have been a slight revision, but in terms of thinking kind of like stocks follow fundamentals in the long term, and you just want to own the companies that are compounding the fundamentals, there hasn't been, at least from a next 12-month estimate point of view, there hasn't been that much that changed in the company, which is quite interesting. All right, so is there, like, do you have any actually, so C Limited is not has no business in China. Maybe I could ask you if you have opinion on kind of what's going on with Chinese shares and some of the companies that are actually based in China.
Well, China was absolutely decimated last year because of the regulatory changes by the government over there. And there was a lot of uncertainty and fear surrounding delistings of certain American companies. And accounting hasn't been very strong for Chinese companies, the ADRs. We've had a number of scandals. And, with the crackdown by Beijing on the technology companies, and also the growing tension between the US and China, I just personally, for my own capital, I just don't think there is any need for me to take on extra risk. It's hard enough to find good companies operating in, the Western world where the corporate governance is stronger and, where you actually own physical shares of the actual business. Because if you invest in Chinese companies, if you invest in ADRs and stuff, as you might know, you don't actually own shares in the underlying business. You own shares of an offshore entity called the VIE, which is a variable interest entity, which has a contractual agreement with the underlying Chinese business to repatriate some of the profits and so forth. So you don't actually own the actual business in China. And as far as I'm aware, although the Chinese government has so far tolerated these structures, I think they're pretty illegal. So, by investing in Chinese companies, Western shareholders and foreigners are taking an extra layer of risk, because if things go, pear-shaped and the Chinese government decides one day, rightly or wrongly, that they don't, recognize these structures anymore, then overnight investors are going to lose virtually all their capital. So although, this has become more widely known, and, this is why the Chinese stocks are now trading at what appears to be a significant discount to, the shares in the Western world, I just don't think there's enough reason for me to take such a huge risk, not because, of the uncertainty surrounding the corporate governance as well as the regulatory framework in China. So, if people want to take risk, by all means, it's just not something I'm prepared to do with my own capital.
Got it. That makes a lot of sense, and definitely a lot of gray area and uncertainty with the VIE structure and what the government's going to do and how they're going to come out at the end, and definitely a nationalistic kind of play here with the government incentivizing or forcing companies to list onshore rather than have these VIE structures. I just pulled up the CQQQ over the past 10 years, and with the drawdown, and we're at about a 50% drawdown, which is the biggest one that we've seen since the share started trading. And you're at this at least long-term support line. Doesn't mean that we'll bounce from here, but kind of interesting, interesting technical pattern in that index. Okay, so are there any specific companies? Maybe I'll ask you about. Would love to know maybe your. Let's go to the other kind of side of the world. Let's talk about MELI for a second. Why do you own MELI?
I mean, MELI is actually my one stock I've owned for many, many years. It's actually one of the oldest holdings in my portfolio. I first invested in shares of MELI in 2010 or 11 or something, when I used to run money for my firm. And I've been a shareholder in my own personal account post-retirement since 2016. And it's just a fantastic business. PayPal owns a stake in the company. The company was founded by Marcos Galperin. He's still a shareholder and a CEO of the company. The business started off primarily as an e-commerce giant in Latin America and South America. But over the years, they've basically transitioned into fintech, and fintech is now the biggest growth driver for the company. And if you look at the projections from the analysts from Wall Street is still looking at over 30% revenue growth for the next 4 or 5 years from this business. And just like C Limited, this stock has been absolutely crushed. It's gone down 50% since November. And the valuation has become pretty cheap. If you look at the earnings, the EV to revenue multiple on MELI is now down to about 6, I believe, for this year, which is basically lower than where it was even during the COVID crash. So it's at a historical low. And I think, this is the time to scale into MELI, because I think shareholders are going to, in my opinion, I may be wrong, but I think shareholders stand a very good chance of tripling their money in the next 5 years or so.
Yeah, so I pulled up the snapshot of MELI here, an overview, and we have this kind of valuation section where you could hover over some of these variables. So if I hover over this EV to sales next 12 months and get the 10-year graph at 6.2, it is the lowest EV to sales multiple that it's had. That's pretty incredible. And this derating that we've had from 20 to 6 has been super violent. And just kind of like looking at its estimates overview, estimates are still going up, haven't really changed. And then for the years are pretty flat as well. So, and then let's just see what analyst estimates are for the stock. So as the stock has come down, so have the average consensus price targets. And now MELI is trading through the low. So the lowest estimate on the street for MELI is 1,250 for the shares, and it's trading at about 1,000. It gives you some context about how much it's hated or how out of favor it is, at least by the market. Cool. Is there kind of like, if you had to highlight one more stock?
I mean, you can pick anything you like.
Cool. Let's. This is a company that I don't know too much about. I've seen it. I've seen other companies use it, but maybe you could tell us about ZoomInfo.
Sure. I mean, ZoomInfo is primarily a business intelligence software as a service offering, whereby they offer their customers, other companies, a database, or a most up-to-date database of the primary contacts within each company for sales and marketing and so forth. So it is a lot easier for companies to contact the key personnel who are responsible for various activities in each company to contact, and they basically pledge that their data is up to date. They've got the most extensive database in the industry, and I think they have become the go-to vendor for business analytics and intelligence from a personnel point of view. And the company is founder-led. The founder is a major shareholder in the company. The forward guidance is pretty strong, both from the company itself. The TAM is pretty big, and the free cash flow is pretty decent, very high margins, recurring revenues. And the company has said that they can comfortably grow in excess of 30% a year for the next several years. So it's my kind of company. I like it very much. I think the company is now fairly valued. I wouldn't say it's a screaming bargain, but it appears to be fairly valued to me at this level. And I think shareholders who invest now will likely do well over the next 5 years or so.
Cool. That's awesome. That's great. Well, thanks for this. Just, I wanted to say that your investment style is really kind of resonates with how I look at the markets, which is a combination of technical, macro, and fundamental. You share a lot of your ideas on Twitter. You get a lot of, I'd say, pushback and a lot of trolling because you do share ideas in public, and people love to pick fights with you. But thanks for kind of keep doing it and sharing your knowledge with other investors, because I know a lot of people kind of learn from the way you look at things, and appreciate the fact that you shared openly, and are so giving with your time, and engaging with other people on Twitter. So really appreciate that.
Well, thank you very much. I mean, it keeps me busy and entertained, because I retired 6 years ago, and I've just been managing my own capital. So, it's just something fun for me to do. And, if I can share my research and if people can benefit from my experience and my knowledge, then, I'm more than happy to post my thoughts on my Twitter account. It doesn't cost me anything. And if it helps other people, I mean, it's wonderful. It's just a great feeling that my, commentary on markets and what I'm doing in my own portfolio is actually benefiting people and having a positive impact on people's financial lives. It's great.
Cool. That's great. Awesome. Well, thanks again for making the time to give us your thoughts on the market. Looking forward to our next conversation. Thanks, Puru.
Thank you very much, Rob. It's a pleasure as always.